For easy, simple, and precise lecture sessions related to BBA, BCom, MBA, and MCom, do like, share, and subscribe to my channel Kanwal Sidhu.
After establishment of business, funds are required to meet its day-to-day expenses. As we know that raw material must be purchased at regular time, workers must be paid at proper time, water bills, taxes are also to be paid regularly. So we can say that for financing such requirements, short-term funds are needed, and the availability of short-term funds is important. And we can say that inadequacy or unavailability of short-term funds may even lead to closure of your business. So these are some of the sources of short-term finance. The first one are the indigenous bankers. The private money lenders and other bankers used to be the only source of finance prior to the establishment of the commercial banks, and they used to charge very high rates of interest, and we can say that they even exploited their customers. But nowadays, with the development of the commercial banks, they have lost their monopoly. But even today, some of the business houses depend upon these types of bankers for obtaining loans to meet their day to day or the working capital requirements. Then second comes the advances. So some business houses get advances from their customers or the agents against the orders, and this is the important source of short-term finance for a business organization. So we can say it is a cheap source of finance, and in order to minimize their investment in working capitals, some firms some firms having long production cycle, especially the firms into the manufacturing industry, prefer to take advance from their customers. Then the third is the installment credit. So this is another method by which the assets are purchased and the possession of goods is taken immediately, but the payment is made in we can say the installments over the particular time period, and generally interest is charged on unpaid price or it may be adjusted in the price. Then next comes the bills discounting. So purchasing and discounting of bills is the important form in which the bank lends without any kind of collateral security. The seller draws a bill of exchange on the buyer of goods on such credit. We can say that bill discounting enables the immediate availability of cash and no extra security is required in this case. Then next comes the trade credit. So it refers to the credit extended by the supplier of goods in normal course of business. As present day commerce is built upon credit, and the uh, trade credit arrangement of a firm with its supplier is an important source of short-term finance. We can say that the credit worthiness of a firm and the confidence of its suppliers are the basis of securing the trade credit, and it is mostly granted on an open account basis where the supplier sends goods to the buyer for the payment to be received in the future. So unlike other sources of finance, trade credit is easy to obtain. Next comes the factoring. So as we know that factoring is basically a financing method in which a business owner sells accounts receivable at a discount to a third party funding source to raise the capital. So factoring is one of the oldest forms of business financing. It is the you can say that cash management tool of your company. So factoring is very common in certain industries such as the industry dealing into cloth manufacturing, where long-term receivables are part of their business cycle. So in a typical factoring arrangement, the client makes a sale and delivers the product or a service and generates an invoice. The factor, which is the funding source, buys the right to collect on that invoice by agreeing to pay you the invoice face value, which can be around 2 to 6%. The factor pays 75% to 80% of the face value immediately, and forwards the remainder when your customer pays to it. So factoring is one of the important sources of short-term finances. So these are the important sources through which the companies acquire funds for their day to meet day-to-day working capital requirements.